Welcome to the Deep Dive, your shortcut to being well-informed.
Today, we're jumping straight into Chewy's latest numbers.
Exactly. We're unpacking their first quarter financials for fiscal year 2025.
Yeah, we've got the official earnings presentation, the call transcript, news reports, the whole picture.
And our job, as always, is to cut through the noise, pull out what really matters for you, and figure out what it means for Chewy and, well, the whole pet industry.
Right, and there are definitely some interesting things happening this quarter. Good momentum.
Okay, let's get right to it. Top-line net sales. What was the Q1 figure?
They reported $3.12 billion in net sales.
And year over year, how does that compare?
That's up a solid 8.3% compared to Q1 last year.
Okay, 8.3% growth.
But here's the thing. That number actually beat the high end of their own guidance. They were guiding for $3.06 to $3.09 billion.
Oh, interesting. So a revenue beat right out of the gate for the fiscal year.
Yeah, definitely a strong start on revenue.
Good sign. Now, what about the folks actually buying stuff? Active customers.
Yep, they ended Q1 with 20.8 million active customers.
And growth there.
3.8% growth compared to last year. And maybe more importantly, they added about 240,000 net new active customers just from the previous quarter, Q4.
Okay, 240K adds sequentially. Sounds like decent momentum picking back up there.
Management seemed pretty positive about it, yeah. Felt like a corner turned, maybe.
Right. So customers are up, revenue's up even more. Usually means that core group, the auto ship folks, are spending more, right?
Exactly. Autoship was, well, really strong. $2.56 billion in Q1.
Wow. And the growth rate on that?
That was up 14.8% year over year, almost 15%.
Huge growth. So much faster than the overall top line.
Yeah, significantly faster. It means Autoship now makes up 82.2% of their total sale.
82%. A record high.
A record high, yeah. It just shows how vital that recurring revenue stream is. It grew about 650 basis points faster than overall sales.
That really highlights the loyalty there. Does that feed into the average spend per customer, that NSPAC figure?
It does.
Yeah.
Net sales per active customer, or NSPAC, hit $583 in Q1.
And that's climbing too.
Yep, up 3.7% year over year. And just, a reminder for everyone, NSPAC looks at the average spend over the last 4 quarters.
Right. So growing NSPAC plus accelerating autoship, it paints a picture of deeper customer engagement.
Exactly. They're not just adding customers, they're getting more from each one, especially the loyal ones.
Okay, so top line story looks positive. Revenue beat, customer adds, really strong autoship driving higher spend. Let's dig into profitability. Gross margin.
Gross margin came in at 29.6%.
29.6%. How's that versus last year? It looks kind of flat.
Well, on the surface, yeah.
Yeah.
Last year, Q1 was 29.7%, but management pointed out something important.
Okay.
Q1 last year had about 70 basis points worth of one-time benefits boosting the number. So if you sort of normalize for that, then this year's Q1 gross margin actually expanded by about 60 basis points year over year. So real underlying improvement.
Got it. That's a key clarification. Underlying margin is getting better. What about adjusted EBITDA, the non-GAAP number?
Adjusted EBITDA was $192.7 million.
And the margin on that?
6.2% adjusted EBITDA margin.
Okay, and how does that compare year over year?
It's up about 50 basis points as reported. But again, if you factor out those one-time items from last year...
The normalized comparison.
Right. The normalized increase is more like 120 basis points year over year. So definitely seeing leverage there too, not just better gross margin.
Suggests they're managing operating costs well too. Any quick notes on SG&A or marketing spend?
Yeah, SG&A was about 18.5% of sales. Advertising and marketing was 6.2%. They did mention the timing of some marketing campaigns affected Q1 spend, but it still showed some leverage grew slower than revenue.
Okay. Let's hit the bottom line then. Adjusted net income. Still non-GAAP here.
Adjusted net income was $148.9 million. That's up 8.6% year over year.
Which translates to per share.
Adjusted diluted EPS of 35 cents.
And how did that $1 of 35 cents stack up against what Wall Street expected?
That actually beat the consensus estimate. Analysts were looking for around 34 cents, so a beat on adjusted EPS.
Okay, beat on revenue, beat on adjusted EPS.
Yeah.
Looks good on the adjusted front. But crucially, what about the official GAAP net income?
Right, always important. GAAP net income was $62.4 million. That's 0.15 per share.
And that number?
Well, according to at least one source we looked at, that GAAP figure actually missed analysts' expectations. They were apparently modeling for closer to $68.9 million, or 0.16 cents per share.
Ah, okay. So that's a wrinkle. Beat on adjusted, but missed on GAAP. What does that usually tell you?
It often means that while the core operations are improving, like we saw with the normalized margin expansion and cost control reflected in adjusted EBITDA, there are other factors, maybe things like stock-based compensation or other non-cash charges that get excluded from adjusted numbers that pulled the final GAAP result below expectations this time.
So operational health seems good, but the full GAAP picture wasn't quite what analysts modeled. Something to watch.
Definitely. You need both views.
Okay, good clarification. Let's shift to cash. How much free cash flow did they generate in Q1?
They generated $48.7 million in free cash flow.
And that's cash from operations minus capital spending, right?
Exactly. $86.4 million from operations minus $37.7 million in CapEx gives you the $48.7 million.
Still buying back shares, too.
Yep. They spent $23.2 million to repurchase about 665,000 shares in Q1.
And they still have authorization left for more.
Oh, yeah, quite a bit. Around $383.5 million still authorized.
And their overall war chest, cash position, debt.
And in Q1 with about $616 million in cash and equivalents. Total liquidity, including their credit line, is around $1.4 billion. And importantly, still no debt on the balance sheet.
Very healthy financial position. Okay, so let's connect the dots. Why did the numbers look like this? What drove that renewed customer growth and the Autoship acceleration?
Well, man, we talked about two things driving customer growth. Good numbers on new customer additions, but also better retention, lower gross churn.
Fewer customers leaving.
Exactly. And they specifically mentioned feeling that the customers they're bringing in now are, quote, higher quality than maybe some acquired during the pandemic boom. More likely to stick around and spend more.
Focusing on lifetime value, essentially. Makes sense. Any specific product areas doing particularly well?
Yes, hard goods really stood out. Things like crates, toys, beds. That category grew 12.3% year over year.
Wow, that's strong for non-consumables. Why?
Management linked it directly to efforts they've made to refresh the product selection and just make it easier to shop those categories. Like they added over 150 new brands recently.
Okay.
And they also sped up how quickly they can get new products listed online, cutting the time by like 40% to 50%. Faster means fresher selection.
That agility must help. Now, beyond the core e-commerce, they talk a lot about these strategic initiatives, building moats. How's Chewy Vet Care CVC doing?
It's expanding steadily. They're up to 11 clinics now across 4 states. Opened 3 just since the last update.
And the plan is more this year.
Yep. Planning another 8 to 10 openings through the rest of fiscal 2025. And importantly, they said the early signs are really positive. Demand is strong, and it's helping the whole Chewy ecosystem more than they expected.
How so? Is it bringing new people to Chewy overall?
Yeah, significantly more than they first modeled, actually. They said new customer acquisition through the clinics is much higher than planned.
That's a key synergy.
And get this, about half of the new customers who visit a clinic for the first time end up buying something on Chewy.com within 30 days.
Wow, okay, so the clinics are definitely feeding the online business. That taps into that huge vet services market, right? Around $20 billion.
Exactly. And opens doors maybe down the line for telehealth, insurance, things like that. It's a big strategic play.
Makes sense. What about the other big one, sponsored ads? How's that business developing?
It showed sequential growth again this quarter. And the big news there was migrating to a new tech platform.
What does that allow?
It's letting them expand off-site, so placing Chewy ads on places like Google Search or social media, not just on Chewy.com. And they said demand for those off-site ads is already exceeding their expectations.
Interesting. And this whole ads business, it helps margins, right?
Hugely. Management called it the single biggest driver of their gross margin improvement year over year.
Wow.
Now, the off-site ads might have slightly lower margins than on-site because they have to pay Google or whoever, but overall, it's still a very high margin business compared to selling physical goods. They're still aiming for it to be 1% to 3% of total revenue eventually.
High margin. Growing fast. Nice contributor.
Yeah.
And then there's the newest initiative, the Chewy Plus membership.
Right. That's officially out of beta now, fully rolled out. It's that paid annual program, $49 a year after a trial.
And the perks are things like free shipping, some rewards.
Yeah, free shipping, 5% back on Chewy brands, exclusive deals, things designed to boost loyalty and frequency.
And the early results. Is it working?
They said they saw strong signups and good feedback in beta. And crucially, the members are behaving differently. They're logging in more, ordering more often, buying across more categories than non-members.
So it is driving incremental profit.
That's what they indicated, yeah. Driving incremental contribution profit. So it seems to be achieving its goal so far.
Okay, so if you step back and look at Autoship, Then add CVC, sponsored ads, and now Chewy Plus. What's the big picture strategy connecting these?
Well, that's exactly the mode idea they keep talking about.
Right.
Autoship is the foundation. Then CDC helps acquire customers and builds loyalty. Sponsored ads increases the value per customer interaction. Chewy Plus adds another layer of stickiness and frequency.
It's like building an ecosystem.
Exactly. An ecosystem-type concept, as they put it. It's all about acquiring customers, getting them locked into recurring purchases via Autoship, and then using these other programs to deepen the relationship, increase engagement, and capture a bigger share of their total pet spending over time. It's designed to be a self-reinforcing cycle.
Makes a lot of sense strategically, layering those benefits. So looking forward, what did they guide for Q2 and the full year?
For Q2, they're expecting net sales between $3.06 billion and $3.09 billion. That's about 7% to 8% growth year over year.
Okay, and earnings?
Adjusted diluted EPS for Q2 is guided between $0.30 and $0.35.
And for the whole fiscal year 2025, did they update that outlook?
They maintained the full-year outlook. Net sales still expected between $12.30 billion and $12.45 billion. That's roughly 6% to 7% growth. Adjusted for that extra week they had last year.
Right, the 53rd week adjustment. And the profit margin for the year.
Adjusted EBITDA margin outlook also reaffirmed, between 5.4% and 5.7%.
Now, given they beat Q1 and the Q2 guide looks solid, did they give any sense of maybe hitting the higher end of that full year range?
They did hint at that, yeah. Said that based on Q1 and the Q2 forecast, they're currently trending towards the upper half of that sales range. And they suggested they might have flexibility to raise guidance later if things keep going well.
So cautious optimism there, that ties into their longer-term goals, right? They have that 10% adjusted EBITDA target.
Exactly. And reaching the midpoint of this year's guidance, around 5.6%, shows really significant progress towards that 10%. I mean, think about it. They were at 3.3% margins just 2 years ago in FY23.
Wow.
So getting to 5.6% this year would mean over 220 basis points of margin expansion in just 2 years. Clear progress on that path.
That is rapid improvement. And is cash flow expected to follow that profit growth?
Yes, they expect about 80% of that adjusted EBITDA to convert into free cash flow for the full year.
Which should be around
$550 million in free cash flow at the midpoint of guidance. And they're keeping capital spending pretty tight, expecting it at the low end of the 1.5% to 2% of sales range. Efficient spending.
And how does this 6-7% growth guidance stack up against the overall pet market growth? Are they still taking share?
Oh, definitely. The industry overall is expected to grow maybe 3% to 4% this year. So Chewy growing at 6-7% clearly means they're gaining market share.
Did they quantify that share gain?
Yeah, they updated their estimate. They now reckon they're capturing about 50 cents of every dollar that moves online in the pet space, up from maybe 42 cents they talked about before.
So grabbing a bigger slice of the online pie?
Exactly. And they stress this growth is structural, driven by their execution and getting these higher quality customers, not just riding price inflation. They said any potential tariff impact is minimal and already baked in.
Good context. One last thing, there was some executive news.
Yes, the CFO, David Reeder, is leaving. He's moving on to take a CEO job in the semiconductor industry.
Okay, moving to a CEO role. Is it an abrupt departure?
No. Sounds planned. They said he'll stay on for several weeks to ensure a smooth transition.
Got it. Okay, so wrapping it up. Strong Q1 beat on key metrics, good acceleration in Autoship and customer ads, steady guidance for the year with maybe some upside potential, clear progress on profitability, and these strategic moats like CVC and Chewy Plus seem to be gaining traction.
Yeah, that sums it up well. It really feels like a story of solid execution combined with those longer-term strategic investments starting to pay off.
So here's something to think about, a final thought for you. Chewy keeps gaining market share, attracting these higher quality customers, they say, through this expanding ecosystem, Autoship, CVC, ads, plus while the overall industry grows more slowly. What does this multi-layered approach tell us about where online pet retail and services are headed? How might the way these moats work together really change the game, not just for Chewy, but for everyone else trying to compete in this space down the road?
That's the key question, isn't it? How sustainable is this model, and how much does it reshape the competitive landscape? Definitely something to watch.
Thanks for joining us for this deep dive. We'll catch you next time.